Hi everyone, and welcome to today's Greenstone webinar on the US SEC climate rules, where to start and how to future-proof your data. In today's 30-minute webinar, we've got quite a packed agenda in terms of what we're going to be covering today. We are going to start off looking at the background of the proposed US SEC rules and which companies will be affected. We'll then have a closer look at the proposed disclosure requirements and specifically digging a little bit into the scope 3 side of things. And then I guess most importantly, we're going to think about where companies can start in terms of preparing data and thinking about reporting, how software fits into that, and then what's next in terms of the requirements. So I'm David Wynn. I'm the Chief Product Officer at Greenstone, based in our New York office. And for those not as familiar with Greenstone, we're a 15-year-old sustainability software company. So we provide award-winning ESG software to organizations to help them manage ESG data within their own operations, within their supply chains, and within their investments. So to kick things off today, I'm just going to give a very brief introduction to what the US SEC climate rules are. So in March 2022, the US Securities and Exchange Commission released a proposal for public companies to begin reporting their carbon emissions and reductions progress alongside their financial results. It's important to note that these are proposed rules, and there's then been a period of commentary where companies have been able to comment on the proposed rules that the SEC are planning, which are now being taken into consideration. And the rules themselves, the main goal of them is to make corporate sustainability reporting more common, consistent, and standardized, much like financial accounting and reporting. And similar to recent EU corporate sustainability reporting directive that we've seen in Europe. So if we peel back the layers a little bit in terms of the actual rules themselves, what they would require is registrants to provide certain climate-related information in their registration statements and annual reports as it relates to climate details. They would require information on climate-related risks that are defined as reasonably likely to have a material impact on its business, results of operations, or financial conditions. And we'll dig a little bit more into what we mean in terms of materiality a little bit later on. So the required information about climate-related risks is also proposed to include disclosures on greenhouse gas emissions, as well as looking at certain climate-related financial metrics, which would be required in the audited financial statements. So these proposed regulations are coming at an interesting time, and for any organization that engages with or tries to navigate the ESG reporting landscape, it can be a complex and tricky world. Sometimes it's a little bit of a word search out there in terms of all the different acronyms and letters that are floating around related to different standards, frameworks, requirements, rankers, raters within there. And so for many years, the industry more broadly has called for harmonization and standardization, and investor audiences in particular would place a high value on comparability of data to be able to assess and compare the performance of different companies when it comes to ESG metrics and then specifically climate as well. One point I touched on there, which I thought might be useful just to clarify, is the difference between frameworks and standards. So amongst all of these different acronyms that are out there and these voluntary frameworks and standards that an organization might use, the frameworks are looking to provide principles and guidance for how information is structured and presented in reports. By contrast, standards are about ensuring granularity, reliability, and comparability of topics for stakeholders, investors, and corporates. So with the US SEC requirements, that's obviously looking at a compliance requirement, but it's coming into quite a complex ecosystem of different standards and frameworks that a company might already be using to define what's material or structure their climate disclosures already.